Welcome to session 9 of Finc 301. My name is Dr. Vera Fiado, and today we'll be dealing with cash budgets, the cash conversion cycle, and free cash flows. As indicated in our previous session, in business, cash is king. So clearly mapping out the pathway of cash within a business is crucial if a firm is to avoid any uncertainties or any surprises in relation to its cash payments and its cash situation. Now, at a day-to-day business management, cash is fundamental because a firm may just find itself in a liquidity crisis if it does not take its cash management seriously. So then we're going to use this session to look at how to plan in advance for cash inflows and outflows to ensure that there's a complete match in our inflows and outflows to facilitate good business or business survival as the years go on. At the end of the session, we are seeking to get students to be able to put up a cash budget and also to ensure efficient cash flow management. Now, what is the relevance of a cash budget? Now, the cash budget is actually the primary cash management tool. What it does is to forecast cash inflows and outflows and then use the ending balances to predict the loan needs and funds available for temporary investment. Now, we can have a cash budget for daily purposes, weekly, monthly, depending on the purpose for which we would use the budget. And then we can also have monthly for annual planning, and then the daily one is for actual cash management for day-to-day use. Now, when you need to put up a cash budget to help plan for your cash needs, you need to start by first forecasting your sales. As mentioned in our previous session, sales is a very intrinsic part of any business because every business is in business to generate sales revenue and to improve it. So every decision taken usually is linked to the sales of an organization. So then we're going to forecast our sales, and then we're going to look at the information on collections and determine at what point we need to have a fair understanding of how much we're able to collect in the month of sale, in the months that follow, and how much of it may actually go into bad debt. Then we also need to forecast our purchases and the payment terms that we use in making payments for these purchases. And then we also need to forecast other cash expenses such as wages, salaries, taxes, utilities, what have you. Anything that is an actual cash expenditure. And then we also need to know how much cash we normally have on hand and what our target cash balance will be. These are the things that we will require in order to put up a cash budget for a business. Now, look at a sample of a cash budget where in January the firm makes a total collection of 67,651 cedis and then total purchases of 44,000 and then made wages payments for wages of 6,690 and then paid rent of 2,500. In all, the total payments made were 53,000 out of total collections of 67,000. That means that the firm has a positive net cash flow situation of 13,000. In February as well, the firm collects 62, makes purchases of 36, wages of 5,400 and beyond, rent of 25. Total payments for that season is 44, making a positive net cash flow of 18,300 and beyond. Now, if for which reason the firm has to start, it's got a beginning balance of 3,000. When it brings in the net cash flow, it means its cumulative cash balance at the end of January is approximately 16,857. However, its typical target cash balance is 1,500 because based on whatever estimations, it presupposes that it would only need 1,500 to be in operation. Then it means it has a surplus of 15,000 to put away. Now, with that, it moves on to February, where its cumulative cash balance would be 16,000 that is, and then it would put in the 18,000 that is made from the previous slide in terms of the net cash flow, and that brings us to a cumulative cash of 35,000. Since its needed target cash balance is 1,500, it's got approximately 33,000 surplus, which it can invest in marketable securities and other short-term investments, as we discussed in the previous session. So now these are the things or the benefits of projecting. Now, there's no story that it needs to be projected for only 1 or 2 months. It can actually be projected for 6 months to a year and beyond, so that it facilitates. Now, when that is done properly, what it has to do is to ensure that at any point in time, the firm knows in advance whether it's going to run short of cash or it's going to have excess cash, and then takes appropriate steps to manage whether it's an excess source or it's actually a deficit. Now, failure to do so, therefore, then may mean that a firm could only realize that it's having a cash shortfall when it is too late to take certain remedial actions. Because by starting or putting in place a cash budget, the firm is able to project way in advance how much it needs to borrow, and then begins to speak to their bankers to make those arrangements possible. But if it waits too long, it might find itself unable to meet the relevant payments in a season where its collections are way below its payments, for which reason it's got a negative cash balance. So that's one of the very important factors or the reasons for which a cash budget is relevant in a business. Now, what should you include in the cash budget? We've already mentioned it has to do with every item that is a cash element. So no, depreciation is a non-cash charge, so depreciation charge cannot be included in a cash budget, but taxes do get into the cash budget and are considered in the computation of net cash flow situations. Now, aside from collections, what other sources or inflows can you consider? You could actually have proceeds from the sale of fixed assets. You could have proceeds from stock and bond issues. You could also earn interest, and if you have to have court settlements, these could also be featured in, and they should be featured in the period in which they are due for receipt and not otherwise. When you have to incorporate interest, you look at it in terms of the interest and you add a line in the collections section. And if you have to incorporate interest paid, it must be in the disbursement section. And so interest on any other debt will need to be incorporated as well, whether it's for being paid, and if it's an investment, it must be incorporated as such. Now, bad debts, yes, must be incorporated because they actually affect the amount of collections that are feasible. So, for example, if a firm has about 3% bad debt, then its total collections will only be 97% of sales. Failing to recognize this may actually result in an overestimation of collections and render the cash budget useless. Now, lower collections as a result of bad debt will therefore lead to lower surpluses and the possibility of higher borrowing requirements. And so bad debts should not be ignored when you are constructing a cash budget. Now, the reason that we do construct a cash budget is as much as possible to avoid cash flow problems. Now, these are some of the angles or the sources from which cash flow problems could arise. When we make losses, we could run into problems as far as cash flow is concerned. Inflation can also be a problem because then it renders the purchasing power of our funds to reduce. Now, growth can also cause cash flow problems because what it does is to stretch the funding thin for a business such that it is not able to meet up all the obligations as a result of its growth. And we also have seasonal businesses. In seasons where the firm may need to acquire more, it may find itself unable to raise the needed funds to do so. And sometimes one-off items of expenditure could also cause issues as far as cash flows are concerned. So managing that it's very relevant for every business. Now, in relation to the same, we've also looked at the fact that managing your cash flow is similar, typically akin to managing your cash. So you can postpone capital expenditure, you can accelerate your cash inflows, which you've already dealt with, and then you can revise past investments, sell off previous assets, and also begin to scale down on business if the need be. Now, in the vein of managing cash, another item we want to look at related as it is to cash is free cash flows. Now, free cash flows has to do with the amount of cash that is, or free cash that is made available, or cash flows are made available for distribution to investors of the business. Now, when we say investors, we are not limiting this to just stockholders or creditors, but the two groups, so that after making payments on current expenses, taxes, and investments necessary for growth, what we are left with is what we refer to as free cash flow, and this is to be distributed to shareholders as well as creditors. Now, what determines the free cash flow of a business? Typically, is the sales revenue, the current level, the growth rates that we have in sales, and if possible, the long-term sustainable growth rate in sales. These are factors that influence the volume of free cash flow that we have. Then also the operating costs of the business and taxes and other required investments in terms of building, machinery, and inventory. Now, to compute the free cash flow then, what we're going to compute is to get our after-tax operating cash flow. We take out any increase in net operating working capital, and then we take out any increase in long-term assets, and what we are left with, that is, so tax from after tax cash flow from operations, we take out any increase in working capital, and then we take out any payments we've done in addition to long-term assets, and what is left is free for distribution, referred to free cash flows. Now, going further then, we need to be able to map out how cash flows through the business and for what walks through the business, so that we would know when cash comes in and when cash goes out. That way we facilitate efficient planning and ensure that as much as possible cash flows into the firm at the time when it is needed and flows out only when it can be afforded. So the cash conversion cycle tries to measure how long cash is tied up in inventory before cash comes through inventory through to collection before. So you can look at it from this angle: the point where cash leaves the firm and the point when cash comes back into the firm is referred to as a cash conversion cycle. Now, the cash conversion cycle has three distinct parts. First, we're going to look at our inventory holding period. Now, this we have come across in terms of the inventory holding period from our days of ratio, where it tells us how long our inventory takes in our warehouse before it is sold. Then after it has been sold, if it is sold on credit, then it will take a number of days before the money is also collected from clients. Now together, the point from which inventory is brought in and sold and then also collected from the clients in terms of cash collection from the clients, we refer to that as our operating cycle. It means when materials come in, converted into goods, sold to the client, and ultimately the client pays up. It means we have finished one operating cycle. Now, because there's a possibility that inventory may be bought on credit, it means it may take a number of days into our inventory cycle before we are made to pay for the goods that we have acquired. Now, the payment for the goods acquired is usually captured by the accounts payable period. Now, so once we have our operating cycle and we take out the period for which suppliers give us credit, then we are able to compute to a large extent when cash actually leaves the firm and when cash returns to the firm. So now this is a graphical representation or the illustration. So an order is placed, raw materials brought in, an invoice is given. From the time that we have the inventory going into production as well up to the sale, we have the inventory holding period. Then, after the goods are sold, until the point where we receive actual payment from the client, we call that the collection period or the debtors period. Together, the two give us the operating cycle. Now, after a while, we are able, so even though this is supposed to be the whole period for inventory holding, we get to pay for the, so the operating cycle starts, as you can see in green here, from the time that the delivery of the goods in the warehouse up until the actual payment. That's the operating cycle. Now, the time period that we pay, so on this day, then we have cash leaving the firm to pay for the goods we have acquired. But on that day, we have no cash from our clients. So from the day that we pay for the raw materials up to the date that we also receive payment from our clients becomes our cash conversion cycle. Now, a firm is efficient if it's able to make sure that its cash conversion cycle is as minimized as possible, in which case then it has a very short time between when they make payments for goods purchased and receive payments for goods sold. The shorter the period, the less the stress in having to raise external funding at high interest rates to sustain the business until money comes in from clients. So this is the formula for determining the cash conversion cycle. That is the days that the inventory has stayed in the warehouse plus the days it takes for you to be able to collect from your customers, less the number of days that your supplier gives you to be able to pay up. And so that for firms that carry significant inventories and have large receivables, it helps to determine how effectively it's also managing its working capital. Long cash conversion cycles usually translate into issues of illiquidity and high debt payment or interest payments to your bankers, because it means you may have to raise funds to fund the business during the time that money is outstanding from clients. Now, that brings us to the end of our cash management, our cash budget issues. Do not forget to read your recommended text and practice the end of chapter questions for more proficiency. Thank you.